Hey, good morning, guys. Welcome to VA Friday. Sorry, I haven't done a video in a while. I had a really tough time trying to figure out what to talk about. I feel like I talked about everything, but I forget that we always get new people in this group. So today we're going to be talking about how rates compare to other loans when it comes to VA. So before I get right into it, I'm going to do a quick dad joke. Dad joke today is, why don't monsters eat ghosts? Why don't monsters eat ghosts? Because they taste like sheet. Tastes like sheet. All right, so getting right into it. So over the last couple of years, and since I've been in this business, everyone's always asked me, what's the VA rate and all this stuff and how it compares. And I even heard some things where people have said that the VA rate is higher than all the other rates, which is crazy to me. It's kind of wild to think that there's people out there that think that or have been told that. So I'm going to kind of get right into it, and I'm just going to let you guys know what it actually is. So typically the VA rate there's not just one VA rate. It's just how the market is. It's the VA does not establish the rates and what it is. It's not like, these housing finance commissions where they establish one rate and that's all they get. It's just as subject to the conventional rates are, as well as FHA rates. They move constantly up and down multiple times a day and every single day, on a week to week, on month to month. So it is subject to the free market. So which means it goes up, it goes down, just like stocks do. So for conventional rates and VA rates, they all trend about the same way, but they're as far as their overall number, as far as how they are different, VA rates are typically better than conventional rates by 0.5%. Now, why is that? Well, just like anything else, the best way to describe it is that mortgages can be mortgage-backed investments or mortgage-backed securities, which are basically bonds, can be bought and sold. So when these prices go up and down, it does impact the mortgage rates, just like it does in the stocks. So if the stock prices gets bought a bunch, the value of that stock goes up higher because it's more in demand. Similar in this way, where the mortgage-backed security, which is bundles of mortgages together, if there's more demand, there's more people that are going to be buying it. The mortgage-backed security gets more expensive. But what's nice is that it's the opposite effect on the rate, where actually the rate goes down when the demand goes higher. So that's kind of a weird snippet there. But for the most part, to give you guys an answer, when it comes to conventional rates and VA rates, and most government loans, conventional is about 0.5% higher. Now, when I say government loans, this includes FHA, VA, and USDA. So government loans, and then there's conventional loans, Fannie and Freddie. So now they're at 0.5% better because they perform typically better, because if the borrowers are safer, that mortgage-backed security is always going to perform better. Typically with conventional rates is a bit higher because it's less desirable due to a higher foreclosure rate on those types of loans. That's really what it boils down to. So there's just more demand for the government loans than there are for the non-government loans. And that's just generally how it goes. But to give you guys a visual on how it all looks, is that the bottom light green, sea green line is VA, or a representative to most government loans, and then the top one is conventional loans. So this isn't just, this is just giving like the one rate, the par rate, but there isn't just one rate. You can buy down your rate, you can go up on your rate. Sometimes you go up on your rate to save money on your closing costs. Sometimes you go down on your rate to save money on your monthly payment. Just depends on how it goes. But as you notice, they all trend about the same, conventional and government rates, but there is a distinct difference of about 0.5% between those two rates. So now, of course, there's a number of things that impacts an person's interest rate. One is their credit score. Other things are loan amount and type of property that they're buying. Manufactured homes tend to put a little bit higher, or a bit of a higher rate for most loan programs. And there's a slew of other things. But if we were just compare apples to apples, generally VA rates are better than conventional rates. Now, the other thing that we need to compare it to is that this rate is typically consistent to those who are in 660, 670 or above for VA, and conventional, these are people who are generally above 750. So if you kind of think about it, someone with a VA has a VA loan eligibility of 670 is going to get a better rate than someone who's going into conventional. So if anyone's ever tells you that VA rates are more expensive, someone is telling them something wrong or they looked up the wrong information, because VA rates are always typically better than conventional rates, typically. Okay. And same thing with FHA rates. FHA rates and VA rates are typically the same. So, but yeah, there's just not one rate. In this case, we're just comparing apples to apples based on a specific par rate. But when it comes to mortgage rates, there's like a dozen rates a client can choose from. It's not so much if they qualify for which rate they get. They just got to make sure the mortgage payment's underneath their limit. So that's how VA rates, or even mostly government rates, compared to conventional rates. So that's the main thing I want to kind of chat about today, is that, that's what a lot of people out there think, is that sometimes the VA rates are higher than conventional, which I think that's just the silliest thing ever. So hopefully that makes sense. If you guys have any questions, let me know. Otherwise, that's all I got for you. Nuke out.